Most people think financial independence is something you grind toward for 30 or 40 years, then maybe reach at the end of your career, if you're lucky. But what if I told you that's not how it works at all? Financial independence isn't a finish line, it's a spectrum. And depending on where you are right now, you might be closer to your first level of freedom than you think. The problem is, most people never start, or they start too late, and that gap costs them more than they ever imagined. I'm Faisal from LifeWise Finance, and in this video, I'm going to show you what financial independence actually looks like, the levels you can realistically aim for, and what waiting even 10 years to get started actually costs you in real numbers. Let's get into it. Now, quick heads up before we dive in. Nothing in this video is financial advice. Everything I share here is based on my own experience and research, purely for educational purposes. Everyone's situation is different, so make sure you do your own research and consult a professional advisor if needed. This video breaks down three things: what financial independence actually is and what it isn't, the levels of financial independence and which one fits where you are right now, and a concrete startup plan you can act on today. Stick around to the end because the number we reveal in point 3 will change how you think about every year you wait. A lot of people dream about financial independence. For some, it stays a dream. Others plan, act, and make it happen. So, what does it actually mean? Investopedia puts it simply at its core. Financial independence means living your life the way you want, free from financial worry. With this comes the ability to make decisions based on your desires and values rather than financial constraints. And I really like this take from Daniel Darlin, financial advisor at Resource One Advisors. Money doesn't buy you happiness, but it buys you choices. The ability to say yes to opportunities without stress is what financial independence is all about. True financial independence isn't just about wealth, it's about designing a lifestyle that feels fulfilling. That's it. Financial independence isn't about being wealthy or rich, it's about options. Not being forced to trade your time for money, not staying in a job you find pointless, surrounded by people you wouldn't hang with in the first place. And here's a misconception worth clearing up. Financial independence doesn't mean you'll just kick back all day doing nothing, living like a full time retiree, which is not true. Financial independence is more like a volume knob. The higher you turn it, the more options you have to decide what you want to do with your time. And that matters because time is the one resource you can never get back. Once you're in your 40s, you start feeling it in a different way. The years ahead suddenly feel shorter than the ones behind. At least this is the way I personally feel it. So the more financial independence you build, the more freedom you have to choose your own path. Here's a practical way to think about financial independence, not as a single destination, but as a spectrum. Embedded freedom. You still work, but you choose the projects, the schedule, and the people. You can say no to bad gigs. This is where most people aim first. And honestly, for a lot of people, it's enough. Partial financial independence. Passive income or assets cover your core needs. You only work on things you actually want to fund extras. You're mostly free from necessity driven work. Lean financial independence. Your minimal expenses are fully covered by passive income. You simplify your lifestyle and reach independence with a smaller nest egg. Full financial independence. Passive income covers both needs and wants. You could stop working entirely if you wanted. The traditional retiree picture, but on your own terms and timeline. How much you need depends entirely on you, your age, your skills, where you live, your lifestyle, and whether you want to fully stop working or just buy yourself more options. A useful rule of thumb here is the 4% rule. It says that if you withdraw 4% of your portfolio in year one and adjust for inflation each year after, your money should last about 30 years. In practice, multiply your annual spending by 25. If you need 40,000 euros a year, for example, you're looking at a 1 million euro portfolio. It's a solid starting point, not a perfect formula, but a useful anchor for your planning. Here's what I wish someone had told me when I was starting out. I began my freelance career shortly after university. For the major part of that time, I kept saving instead of investing, and inflation quietly ate through everything I set aside. Think of it like this: leaving your savings in a bank account is like leaving an ice cube on a table in the middle of summer. It doesn't disappear overnight, but it's melting the whole time. And one day you look and it's mostly gone. And here's what most people don't realize: it's not just that your savings sit still while life gets more expensive. The mechanism behind it is that governments and central banks continuously increase the money supply. The technical term for it is monetary expansion, which means every euro or dollar in circulation gradually loses purchasing power. More money chasing the same goods. Prices go up, your savings go down in real terms. What you could fill a grocery basket with for 50 euros 10 years ago, that same 50 euros barely covers half of it today. Nobody sits you down and explains this. You just slowly notice that things cost more and wonder where your money went. That's why saving alone isn't enough. You need your money to grow faster than it erodes. And that's exactly what investing is for: going away from fiat money and acquiring hard assets like ETFs, real estate, or Bitcoin, the only crypto I personally consider worth holding. That increase in value over time. If I had started investing back then, my portfolio today would be two, maybe three times larger. That's not an exaggeration, that's just compounding doing its job. Compounding is when your returns start generating their own returns. In the early years, it feels slow because your principal is still low and it only increases through your own contributions. Then at some point, it takes off and the money starts working harder than you ever could, doing the heavy lifting for you. The secret behind this is mathematics. The growth we're describing here is not a linear curve, it's an exponential one, which is why it feels almost flat during the first 8 to 10 years. But here's what that actually looks like in real numbers. If you invest 10,000 euros at age 25 with an average annual return of 7%, roughly the historical inflation adjusted return of a broad index like the S&P 500 over the last 100 years, by age 55 you'd have around 76,000 euros. Wait until 35 to start, and that same 10,000 euros only grows to around 38,000 euros by 55. Same money, same return 10 years later, and you end up with half. That's not a small difference. That's the cost of waiting. The takeaway here is simple: start as soon as you can. No matter how little you can put aside, don't underestimate the power of compounding. The practical level of financial independence I want to highlight, and the one I'm personally aiming for, is embedded freedom. You don't need a massive fortune to get there, just enough passive income or assets to cover your core needs while you earn the rest through work you actually choose. No hierarchy telling you what to think, no corporate rules that flatten your creativity. Just projects that match your values and the people you really see yourself dealing with in your work. To be honest with you, this path is not for everyone. If you have a mortgage, young kids, or a career you truly love, your version of freedom will look different from mine. But here's the question worth sitting with: what would your life look like if you only worked on things you actually choose? If you can answer that, you already know what level of financial independence to aim for. Everything else is just math. So let's make all this actionable. Here's where you start. Step 1. Get clear on what freedom means to you. Grab a piece of paper and write down your top 3 life priorities. How you'd actually spend your time if money stopped being the constraint. Make it specific, make it personal and real. For me, it looks like this: living in a warm coastal region where I can spend more time on the water and outdoors, working on projects that I like, which align with my vision of life, without having to deal with toxic managers and environments I wouldn't choose to be in, and not having to participate in a financial system that's rigged by design to exploit me and keep me stuck in a rat race, living from paycheck to paycheck. Your list will look different, but write it down and make it real. Step 2. Cover the basics. Build a financial cushion as an emergency fund. Aim for 6 to 12 months of expenses sitting somewhere safe, in a separate account. Eliminate a high interest debt first. It's bleeding you every month and preventing you from reaching your ultimate goal, financial independence. Then, automate your savings and broker transfers. Remove the decision entirely, so the money moves before you can spend it. Pay yourself first. Always, no matter what happens. Expenses come after that. Step 3. Start investing. Low-cost index funds, or ETFs, are the simplest, most proven starting point. An index fund is basically a basket of stocks that tracks the market. Think the S&P 500 or a global equivalent like the FTSE All-World. Instead of picking individual companies, you own a small slice of hundreds of them at once. Low fees, low effort, and historically one of the best performing ways to grow wealth over time. And if you're a freelance or running your own business, productize what you already do. Stop trading hours for euros, because if you only earn when you work, you're still on someone's clock, which is essentially a disguised form of wage slavery. As a freelancer or business owner, you already understand this trap better than most. Now it's about going further, packaging your skill into an offer, a course, a retainer, something that earns while you sleep. Your ceiling is much higher than you think. If you're an employee, the levers are more limited, but you can still move, upskill, shift into a higher value work, or start building something on the side. Either way, income growth is one of the fastest levers you have on the path to financial independence, especially in your 30s. Step 4. Revisit and assess once a year. Adjust your spending target, your portfolio goal, and the balance between work and projects. Your life changes, and your plan should too. That's the overview. If this video got you thinking and you want to go deeper on how to actually start investing in Europe, which brokers to use, and which ETFs to pick, that's exactly what I'm covering next. Subscribe so you don't miss it, and I'll see you in the next one.